Alright, so today we'll be looking at the introduction to accounting. And just in case you want to know a little bit about me, my name is Sharakopoko Frempong. I'm a chartered accountant. I'm a certified information systems auditor. I'm a financial modeling evaluation analyst and currently work as a manager at Financing Consult, which is an audit firm here in Ghana. I have experience in consulting. I've been consulting for companies across industries in areas of financial reporting, tax, conducting audits around. Also, with regards to training, I conduct training for both individuals and corporate bodies on financial reporting, audit, tax, risk management, and many more. I'm a member of the Institute of Chartered Accountants Ghana and also the Cybersecurity Expert Association of Ghana and the Institute of Internal Auditors. So let's go into accounting. So accounting is the process of recording, classifying, summarizing, analyzing, and interpreting business transactions. Now there are many items that businesses keep records of, and all the records that are being kept will fall under either an asset, liability, equity, revenue, or expenses. Now this is a systematic process that is being followed by every bookkeeper or an accountant. So anytime there is a transaction, the transaction needs to be recorded. Now in the process of recording the transaction, it has to be classified. So that is where you assign the transaction to one of these items. Then after that you summarize. Okay, so you classify if the transaction should fall under asset, liability, equity, revenue, or expenses. Then with the summary, that is where you get to present totals or you get to present statements. The common form of the summary comes in the form of the financial statement or even the trial balance. Now, after the financial statement has been prepared, there will be a need for you as the accountant to analyze and interpret those statements to your various stakeholders. Be mindful that your stakeholders may not have an accounting background, so they would rely on the analysis and interpretation that you will do to make their informed decision. Now, anytime we talk about assets, we are looking at anything of value that is being owned by the business. Liabilities are basically the debts that the businesses owe other parties. With regards to the equity, we are looking at the worth or what we call the capital of the business. Revenue is just the income that has been generated by the business as a result of its business operation. Then the expense has to do with all costs that is being associated with the business operation. Now, when it comes to accounting, we have branches of accounting. We have the financial accounting, we have management accounting, we have tax accounting. So depending on the area in which you want to go. Now, financial accounting basically has to do with the preparation of the financial statement, summarizing past events, which are the transactions. So the transactions have already occurred, so they are past events, which is usually in the form of profit or loss account and also the balance sheet. So basically, the responsibility of the financial accountant will be to prepare the financial statement, which comprises the profit or loss statement and balance sheet using past event or historical event, or what we also call the transactions. Then we have what we call the management accounting. So the management accounting is basically the provision of much more detailed information, and it is more of current and future plan event to allow management to carry out their roles of planning, control, decision making, and performance evaluation. Mostly the accountants at this level are referred to as what? As management accountant. Then we have tax accounting. So the financial statements are actually prepared using the generally accepted accounting principles, the International Financial Reporting Standards, which we refer to as IFRS. Then we have International Accounting Standard IAS. Right. Now, accounting standard allows flexibility in the treatment of different items which may not be acceptable to the tax authority. So the preparation of tax return has become a specialized field, and tax planning requires thorough knowledge of the tax law. Now, the tax accountant, or when it comes to tax accounting, It's basically trying to modify the financial statement that has been prepared by the financial accountant to suit the local laws or the tax laws of the jurisdiction in which you find yourself. There are some expenditure or there are some transactions that are going to be treated by the financial accountant in preparing of the financial statement, but the tax laws may have their own treatment. Some of them may be allowable, some of them may not be allowable, and there will be a need for a tax person, and there will be a need for a tax accountant or someone with knowledge of tax to modify the financial statement to suit the tax laws. Let's move to the difference between management accounting and financial accounting. Mostly people get confused as to the difference between them. With regards to financial accounting, it is designed to provide information to a wide stakeholder group, whilst management accounting provides information principally for internal use by management. So if you are looking at it from stakeholder, management accounting is just for management, then financial accounting is for almost everyone. Financial accounting provides information on business as a whole, whilst management accounting mostly focuses on performance of various divisions, departments, and other units. So when it comes to management accounting, we want to find out if this particular product line with this particular division or this particular department, are they being profitable? What are their inflow? What are their expenses? So you get to have a more detailed information, whilst financial accounting report as report on the business as a whole. Financial accounting is concerned with the monetary records of past historical events, whilst management accounting uses historical and current but focuses more on what future unit analysis and decision making. So you can look at management accounting as like budgeting, forecast, projection. Right. Before we do that, we will look at our trend for previous years. So what has been our profit margin, what has been our revenue margins, what has been our assets, and all those stuff. So you use those historical information to build an analysis and make some decision. So that is the management accounting, whilst financial accounting uses those past records or past information to prepare the financial statement. The period for reporting is much longer in financial accounting, so we mostly do yearly or half year as compared to management accounting. Your director may tell you to submit a weekly report, daily report, or monthly report. That is tied to management accounting more than financial accounting. So financial accounting report has to be precise and follow certain laid down guidelines, and that has to do with the IES, the IFRS, and also with the GAAP, the generally accepted accounting principle, depending on the one that is being used in the jurisdiction in which you find yourself. But with regards to management accounting, there is no precise way of presenting your information so far as management will be able to understand and make their decisions or analysis. That is fine. Okay, let's look at the aim of accounting. So the aim of accounting is to keep systematic records, to ascertain the operational profit or loss of the business, to provide information on the business financial position. So we want to know what the business own, which is the asset, what the business owe. That's to do with the liabilities of the business. Accounting helps people to make better decisions, including assessing opportunities, products, and investment. Now let's look at the components of the financial statement. I know we've heard financial statement severally, but let's look at what makes up the financial statement as a whole. So first we have the income statement, which we also refer to as the profit or loss statement. Basically what this statement does is to show us the profit or the loss that has been made by the business for a given period. We have the changes in equity. So changes in equity shows us the equity component of the business. So we are just looking at the capital. So if is there any capital, is there any additional capital, has there been any dividend payment, has there been any revaluation, and what are our accumulated profit or our income surplus, which is also known as retained earnings. We have our balance sheet, or the statement of financial position. This statement shows us our assets, our liabilities, and also our equity. So your equity balance here will now show in your balance sheet. It kind of provides a snapshot of what the business owns and owes, and as well the amount invested by the shareholders. That is our equity. Then we have our cash flow statement, which is the fourth statement. So the cash flow statement actually shows us the movement of cash for the period, our inflows and our outflows. Then finally, we have what we call the note to the financial statement, or note to the account, which students mostly refer to as workings. Right, so this kind of gives you the breakdown of the figures or the items that went into the income statement, the balance sheet, and cash flow statement. It shows a more detailed information on an item that is contained in either the cash flow, the balance sheet, changes in equity, or income statement. Example can be, let's say, revenue. So in your income statement, you may see revenue of, let's say, 5,000, but the note to the account will tell you that revenue is made up of sales, it's probably made up from proceeds that has been disposed, or any other income generating activity that has been undertaken by the business. Okay. Now, anytime we talk about the financial statement, people tend to think about the quantitative side, but there is a qualitative aspect of the financial statement, and that is what we would like to address. So the qualitative characteristics of the financial statement includes one, understandability. So basically what we are saying is that the financial statement that is being presented should contain information that can be readily and easily understood. So anytime your shareholders or your stakeholders pick your financial statement, they shouldn't necessarily find it difficult to understand. So it means your financial statement should be presented in a simpler manner, in a manner that can be easily understood by everyone. Two, relevance. So we are looking at the kind of information that is being contained in our financial statement, and we are saying that all those information included in the financial statement should be relevant to the economic decisions that our stakeholders will be using that information to make. If they want to use the financial statement to make a decision or as to whether they should invest in the company or not, whatever information contained in the financial statement should be relevant to that decision that the shareholders want to make. Reliability. Now, when it comes to reliability, we are looking at the financial statement being materially free from error. So what it means is that if the financial statement contains a lot of error, then shareholders or stakeholders may not be able to rely on the financial statement to make their decision. So the financial statement should be prepared in a way and manner that we can trust the information and we can rely on it to make our decision. We have comparability. So with comparability, we are just looking at our ability to compare the financial statement that has been prepared by you, the accountant of an entity, to that of the same entity's previous year's financial statement, or our ability to compare the financial statement with another entity's financial statement. So mostly with comparability, it is either over time, that is when you are comparing the same that is when you are comparing the financial statement of the entity with its previous year's performance, or you are comparing it with another entity. Timeliness. Now, if it takes a lot of time for you to prepare your report as an accountant, it is possible that by the time the financial statement is being prepared, shareholders may not have any need for it, because the time that they needed the financial statement to make their decision, it was not made available to them. So this qualitative characteristic is saying that as an accountant, make sure you prepare your report on time so that shareholders or stakeholders will get the information early and use those information to make their decision. We have verifiability, and verifiability, what we are saying is that if we are to bring a different person, an independent person, an expert, someone who is knowledgeable in accounting, if we are to bring such a person, the person should be able to verify, or the person should be able to agree with whatever you have prepared. So if you have prepared a profit or loss statement and we bring in another person, and we bring in another accountant, an expert, to prepare the financial statement, all things being equal, the person should agree, or the person should have something similar to what you have prepared. And we mostly see this in practice where auditors do come around. Now let's look at the limitations of the financial statement. So the financial statement actually prepared based on historical information and may not necessarily reflect current or future thinking of the business. It's possible that there may be a change of strategy that will make the company progress. But if you are going to make our decision as to whether to invest in the company or not, it is going to be based on the financial statement, which is historical and does not include or contain the current strategy that the company is formulating or implementing. Two, it involves making subjective decisions and estimate. It gets to a time where you can't get the exact amount for an item, and the accounting standard allows accountants to make estimates based on their own professional judgment. Example, determining the useful life of an asset. The accountant can only estimate, and sometimes estimation brings some form of discrepancies. 3. Information provided may be legal requirement by legislature or by accounting standard. So whatever information that is being presented, the accountant must comply with local laws. So the laws affecting the jurisdiction in which the accountant find him or herself, and also the accounting standard that is being complied. The financial statement provides only financial information about the business. So information such as quality of product, delivery time, customer service care may be needed by internal users who are also stakeholders anyway. But if you are going to judge the company solely based on their financial statement, then we may miss out on the quality of the product, ability to meet customers' demands on time. We may miss out on those other information. Now there are documents that is being kept by an entity which we call the business document, sometimes referred to as source document, and these records or documents are used by the accountant to record transactions in the company's books or ledgers. These documents are very important because they provide details of transaction that needs to be inputted in the company's internal accounting system on a regular basis. So internal accounting system, you are looking at the accounting software that is being used by the entity. 2. They provide evidence that transaction took place and should be available for year-end audit. So as an auditor myself, anytime I go on an audit, we ask for supporting document or evidence. When the accountant is unable to provide the source document, it kind of raise an eyebrow as to whether the transaction really took place or they decided to just pass the transaction in their internal accounting system. 3. They provide proof of income and expenditure to the tax authority in case they want to also carry out a tax audit. So there are instances where the tax authority would also like to conduct a tax audit, and if you are saying that you've incurred 50,000 on an expense, then there should be evidence with respect to what the expenditure you are claiming. Information contained in the source document. So basically we are looking at the name and address of the entity buying or selling. So if you are buying goods from a supplier, probably you see the supplier's name, you should also see your name. The receipt should be addressed to you, right? You would see the address of the supplier, you would see the date, the amount involved, if there is any taxes applicable, you will see the taxes, you will see the nature of the transaction. So if it is with regards to the buying or supply of goods, works, and services is going to be described in it. And you will see if there are any special terms. Example, if your supplier or you are rather giving discount to your customers, there should be such terms being stated. Then finally, you get to see a signature. So if it is a receipt being written by a supplier, you may see the signature of the supplier, and some of the suppliers would also tell you to sign, right? So basically, these are the information contained in the source document. So as an auditor, if I request for any source document or business document or audit evidence, and you provide the document to me, I want to see it being addressed to you. I want to know the date in which the receipt was written. I want to know the amount involved. I want to know applicable taxes. If you enjoyed any discount, I would like to see all these. Now let's look at some source documents. So we have the purchase order, we have invoice, we have debit note, we have credit note, we have payment vouchers, we have checks, we have journals, we have petty cash vouchers, we have banker's advice, we have bank statement, and we have receipt. It is possible that one transaction you may use about 4 or 5 of these documents. Example, in the case where we award contract to our suppliers, we may issue a purchase order to our supplier to deliver the goods or the product to us. The moment the supplier brings the product, the supplier would also issue an invoice. So we have 1, 2 in the same transaction. And now we may decide to pay the supplier by giving him or her a check. So we have 3 coming into the picture. Then when the check is being paid, the supplier now issues us with what? Receipt. Now because we are paying by check, we may see that transaction also in our bank statement. If the supplier is also paying the check into his or her account, he takes the check to the bank, he may be required to fill some slip, so you may also see this. So as an auditor, when I go on field and I ask for supporting documents, I can also verify that okay, this amount has been paid to this person by check. Okay, let me see, give me the bank statement, let me confirm if I can see those transactions in there. Now the basis of accounting refers to the methodology under which revenue and expenses are being recognized in the financial statement of a business. Now we have 2 primary methodologies, and these are the cash basis of accounting and accrual basis of accounting. Now under the cash basis of accounting, revenue is being recognized when cash is received, okay, and expenses is also recognized when money is paid out. So what it means is that if you sell goods to someone and the person doesn't give you money, you don't receive any cash, you don't recognize the transaction in your books at all. In the same way, if you incur an expense and you don't pay, or you haven't paid, the expenses is not being recognized. It is only recognized when you have paid. This is an easiest approach to recording transactions, and is mostly used by small businesses. Okay, then we move to the accrual basis. So under the accrual basis of accounting, revenue is recognized when it is earned, and expenses recognized when it is what? When the expenditure has been consumed. Now this is what makes accrual different from the cash basis. So we said with the accrual, revenue is recognized when it is earned. So and not necessarily when cash is received. The moment you are entitled to the money, if you are supposed to deliver goods to someone and the person is supposed to pay, the moment you deliver the goods, you have earned that revenue, whether the revenue has been paid to you by the customer or not. So the moment you do your portion, you now go ahead to recognize it in your books as revenue. Then with regards to expenses, so assuming you are on the receiving side, the moment you receive the goods from your suppliers, you have to record the expense, whether you have paid your supplier or you haven't paid your supplier. This approach normally requires a greater knowledge in accounting. It is not easy as the cash basis. Okay, and this is mostly used by every big organization, and this is the concept or the basis that is used in preparing the financial statement of basically every business except the small ones or the organizations that have decided to use the cash basis of accounting. Now we have some accounting concepts and policies, right? And accounting concepts are basically the assumptions which are used in preparing and disclosing items in the financial statement. These assumptions actually underpin, these assumptions actually underpin the preparation of the financial statement. So anytime the financial statement is being prepared, the accountant would have to make some wild assumptions, which are pretty nice, and the assumptions that has been adopted by the management of an entity becomes the accounting policy. Now let's look at some fundamental accounting concept. We have the going concern. So the going concern concept states that the entity will continue to be in existence into the foreseeable future period. And in preparing the financial statement of the company, that is one of the assumptions every accountant, including myself, we make. So every accountant makes this assumption that the business that we are preparing its financial statement will continue to be in existence. The company will not collapse. The company will not go into liquidation, but the company is going to operate into the foreseeable future. And by so doing, balances are carried forward to be used for the next period. That is why you get to see something like carrying amounts, closing balances, opening balances. This is because the accountant has envisaged that the company will still be in existence. So there is a need for us to carry the balances to the next accounting year. Then we have the accrual or the matching concept. This concept actually states that expenditure for a given period, whether that particular expenditure has been paid or not, should be matched against revenue earned for that same period, especially when we want to determine what profit. That is why the profit or loss statement is made up of our revenue and expenses. Now this revenue is not necessarily revenue that this revenue doesn't necessarily relate to transactions that our customers have paid us, but it relates to all sales that we have made, whether the person has paid or the person hasn't paid us yet. The same thing applies to expenses, right? So far as that particular transaction occurred during that period that we want to determine profit, then that particular transaction actually qualifies to be in our profit computation. If you have done a little bit of accounting, you realize that closing inventory is deducted from cost of sales, and it is because those inventory has not been sold, so they did not contribute in revenue generation. By so doing, if we want to determine profit, we have to take the cost of those closing inventory from it. Now let's look at consistency. So this concept assumes that accountants should maintain a specific method of recording accounting transactions for any given period. So this is very, very critical. So although there are many methods which can be used, but for the purpose of comparability we talked about earlier, that we want to be able to compare our current year's performance with our previous year's performance, or even our ability to compare our current year's financial statement with another entity's current financial statement, right? It is very important we maintain one method consistently. So you can't be using accrual concept today, then the following you move to cash basis. It should be used consistently. Now, you see, anytime the method is being changed, then there will be a need for us to disclose it in the note to the financial statement that there have been a change from one concept or one method to another. Prudence. So this concept forbids the accountant from anticipating profit, but the same concept provides that or requires the accountant should make provision for possible losses. So any anticipated losses should be recognized in the books as long as it is foreseen. Then the accountant should make provisions as immediate as possible. Business entity concept. So this concept implies that the affairs of a business are to be treated as being quite separate from the non-business activities of its owners. One of the things we get to see as auditors is that the owners of the business kind of interfere or include their personal transactions to that of the business transaction. But the business is a separate legal entity on its own. It's an artificial person which can sue and be sued in its own name. So the law requires that the business should keep its own books, whilst the owners of the business should also keep their own transaction. They shouldn't be including their personal transactions in the transactions of the business. Periodicity. So the life of an entity is divided into short economic lifetime, and this lifetime is what we mostly use in preparing our financial statement. So you realize that the financial statement is mostly prepared on annual basis, right? So if you want to determine our profit for a given period, this is where the periodicity comes in. So we look at the period, then we determine our profit. Then we have dual concept. So the whole accounting we do actually thrives on this concept, the double entry system. And it requires that all transactions, and I mean all transactions, should have a debit entry and have a corresponding credit entry. This is the only way we can have a balanced financial statement. If we don't comply, we will end up having a financial statement which is not balancing, or we will end up having a trial balance or a ledger which is not balancing. So substance over form, we are saying that transactions and other events must be accounted for and presented in accordance with their substance and economic reality rather than their legal form. So you get to see this, which is being used by the tax authority. In Ghana, we have the GRA, Ghana Revenue Authority, which they mostly use. So if you don't pay your taxes as a business, if you don't pay your taxes, they will come and compute your tax liability and take the money from you, regardless of the fact that the business is registered or not. As to whether the business is registered or not has to do with the legal form. But the moment the substance or the economic reality is that you are engaging in business activities, you are into buying and selling, you are into trading, so far as it's a business activity, they do not care whether it is registered or it is not registered. They would collect their taxes, and that is practical substance over form in play. Then we have materiality and aggregation. So items which are significant enough to affect evaluations and decision making must be disclosed in the financial statement. Remember, we talked about reliability. So if there will be any error or omissions in the financial statement, it shouldn't be material, because if it is material, it is huge, it is something significant, it is something that can affect or influence the decision that I will make. If you told me the financial statement that has been presented, there is an omission of 100,000, I may not be able to rely on the financial statement because 100,000 is significant, 100,000 is material. Now, when it comes to materiality, it varies entity by entity or even industry. There are some entity, 1,000 cedis or 10,000 cedis is not material to them because of the kind of figures or revenue they generate. But if you look at small business, 10,000 or 1,000 cedis is very significant, right? So when it comes to the issue of materiality, it actually varies depending on the entity you are working with. Now let's look at stakeholders. The financial statement that is being prepared is not for the consumption of the accountant. The accountant is actually preparing the financial statement for some people, and these people are what we are referring to as stakeholders. So stakeholders are individuals or groups that have interest in what an organization does. So different groups have direct and indirect interest in what the organization is actually doing, and that matter, it's going to affect the kind of information they will be looking out for in the financial statement. Now, so for management, The information need is for decision making, planning, control, and performance evaluation. Management will ask for the financial statement of an entity to determine if they are actually doing well. They want to evaluate their performance. They want to know where are the areas that we can do better, and also plan ahead and come up with strategies. Okay. Two, employees and their trade union representatives. So they will be interested in profitability, because if the company makes profits, then they are secured with regards to job. There is job stability, and they can go in for promotion and ask for a higher remuneration. When it comes to the public, the community, or the society at large, they would also be interested in the profitability of the business, because if the company is profitable, they can also make up a case that the company should be able to invest in the community by embarking on corporate social responsibility, giving scholarship, building hospitals, and other things. Now we have investors. Now investors, both existing and also potential investors, will be concerned about how management is going to use the money that they will be investing into the business. So that will be their information needs. We have lenders. So those who give us goods on credit, they are interested in our performance or our profitability, because they want to know if we have the ability to pay back the money we owe them. If they give us goods on credit, they want to know we are able, or we will be able, to pay. Then we have government agencies and regulators. So basically we are referring to the tax authority. They want to know if you have been profitable, because if you have been profitable, then there will be a need for you to pay some taxes to the government. Then we have customers. Mostly no one wants to associate him or herself with an organization that will be liquidating or be going out of business anytime soon. So customers want to find out if you have what it takes to be in existence for a very long time, because they would also like to come and negotiate some credit terms. I want you to sell to me on credit, I'll pay you after a month. Who is going to be in business for a very long time, so that they can negotiate those favorable terms. So thank you for watching. If you have any question, you can put it in the chat box. Also, you can reach out to me through my mail, TikTok, and also you can connect with me on LinkedIn. Thank you.